Digital currency. Why banks want to get digital currency? You might already know that since 2018, cryptocurrency has been dominating the whole world economy and has gained recognition that cannot be described in words. But do you know that banks are now trying to convert all the physical currencies into digital currency? Curious? Want to know the reason behind these major changes? Then stay with us until the end of the video and find the answers to your questions yourself. Welcome to Crypto News Now, where as usual, we demystify crypto and present it to you in a simple format. Today we're going to explain every reason to you why banks are converting to digital assets. It's no secret that interest in cryptocurrencies has surged since the COVID-19 epidemic, and this has generated debate among central banks over whether they should create their digital currency. Meanwhile, in China, the sudden interest led to the development of its digital currency, which, mind you, has been working on the initiative since 2014. It's already undertaken several experiments in various key Chinese cities like Shenzhen, Chengdu, and Hangzhou. So with the use of physical cash dwindling, particularly after a year of lockdowns, interest has turned to the central bank digital currencies once more. Over 60 central banks have been looking into CBDCs since 2014, with several already at the trialing stage. But China isn't the only one in this race, as a year-long trial of the digital yen was also started by the Bank of Japan, and the People's Bank of China has tested the digital yuan in Shenzhen, Chengdu, and Hangzhou, as well as celebrated it by holding an electronic wallet lottery. Thus, plans are afoot to allow visitors to use the digital yuan at the 2022 Beijing Winter Olympics. So amidst all of these international issues, let's take a look at why the banks hurrying to get rid of physical assets. According to reports, CBDCs or central bank digital currencies are less urgently needed in developing countries. Thus, in Europe, CBDC developments are slower. But in the past, the European Central Bank has explored the possibility of creating a CBDC for the entire EU. But Christine Lagarde, the president of the central bank, said that it will take at least another 4 years before it is even implemented. And for now, the CBDC of the Bank of England is evaluating the benefits, risks, and practicalities of creating a so-called British Bitcoin. A key element of their work is to identify whether there is a use case for a CBDC. However, in the wake of Hurricane Dorian in 2019, the above-mentioned project lacks what Bahamas' CBDC, the Sand Dollar, had when it was launched. That is, the ability to quickly restore banking services to the outer islands. It was a storm-proof digital currency based on a mobile phone, effectively making it the world's first functioning CBDC. And if you are thinking about this, well, it uses the Sand Dollar. It's allowed Bahamian citizens to electronically send and receive money without the need for a bank account. As a result, modest sums may be moved between islands by phone, just as simple as $5 notes, and that too offline. Thus, CBDCs are underway in emerging economies, and perhaps it's unsurprising that many CBDC projects are underway in emerging economies, including Cambodia, Ukraine, Uruguay, Ecuador, and Turkey. Thus, facilitating financial inclusion is a key factor in the CBDC programs to help to bridge the gap with the unbanked. For developed countries, modernizing the banking system is an obvious benefit of CBDCs. And the Bank of England has made it clear that keeping pace with the digital economy is a key driver of its plans. However, there is skepticism about whether CBDCs would serve a wider need in Western democracies with mature banking systems. So, continuing on from that point, it seems like Western democracies are keeping up to avoid disruption. Thus, CBDCs are attracting a great deal of interest from governments because they want to retain control over monetary systems. They are concerned and will be disrupted by digital assets. For central banks, stablecoins and DeFi protocols are of particular interest as they enable fast payments with little or no transaction fees. They provide attractive peer-to-peer financing solutions, and they are largely insulated from the volatility of other digital assets. Societies are becoming increasingly cashless, and interest in digital assets is steadily increasing. For states to compete or maintain their monetary policy, they will need to come up with a new way to compete. And CBDCs may be the answer to complement and not replace physical cash. So what do you think? Would it be better if banks stay as they are now with their physical assets? Or should they go with the flow and accept the new trend? Now, I guess it would be better to look at what will be the consequences of the previously mentioned changes that take place. First of all is the end of bank runs. Paper cash is essentially a bearer IOU issued by a central bank for the bearer to spend at any given time. In today's digital currency, digital codes issued by commercial banks must be converted into paper cash before the digital codes can be converted. which in turn requires the commercial bank to have paper money on hand to perform the conversion. It's that link to paper cash that gives the digital currency issued by commercial banks value and makes it safe to use. Therefore, there are no runs on the central bank, which eliminate the necessity of protecting depositors from bank runs through insurance plans. And at the level of the overall banking system, all liquidity risks are spread across the entire population, not just each bank's depositor base. Well, the second consequence would be the end of paper cash and private bank deposits, as the central bank would effectively become the only intermediary for financial transactions. So the banks would not be competing for retail and business cash depositors, the success of which currently underlies much of their market value. To finance their lending activities, they will essentially all borrow wholesale from the central banks. The central bank, therefore, would become the lender of last resort rather than the lender of first resort. Having secured funding, interbank competition will be based solely on being able to identify and price good loans, as well as bridge short-term and long-term interest rates efficiently. This will also lower the margins in the business for good borrowers who engage in value-creating projects. Customers will be able to choose from a wide variety of innovative and user-friendly solutions for distributing their economic wallets instead of competing over deposits. Moreover, the creation of the CBDC will also facilitate the entry of new players in the fintech industry, as the established banks' brand reputations as safe custodians of people's money will no longer be barriers to entry, nor will their national branch networks. It will now be the central bank that holds everyone's cash and clear all transactions so that there will be no need for paper money to be converted into digital money. Since a CBDC unit is itself a central bank liability and is exactly equivalent to paper money rather than merely convertible into it. Well, last but not least will be easier regulation and policy execution. In a CBDC world, all transactions could in theory be monitored with the help of data analytics and AI to more quickly identify banks that are struggling or are engaging in questionable transactions. At present, financial regulators must rely on the reports provided by banks, which means that remedial action comes late and often at a greater cost. Furthermore, in a CBDC world where digital bank codes are visible to a clearing institution, it becomes much easier for authorities to identify the parties to a transaction, greatly simplifying the detection of criminal activity and eliminating the black market common in countries that rely heavily on physical money. The changeover also makes it easier to carry out a monetary policy because the central bank may modify supply quickly by issuing or deleting codes in its accounts. Instead of influencing commercial deposit rates through the rates it offers banks on their reserve accounts, with the central bank can directly transmit monetary policy to individuals by paying interest on CBDC holdings. Today, with money held in commercial banks, the policymaker can only influence consumer and business behaviors indirectly. So now, what's your opinion on these consequences? Will it lead to a safer and more flexible economic structure? Or do you think it's going to end up in insecurity and rigidity? Now that we have come to the end of this video, let us thank you for staying with us until the end. Don't forget to let us know in the comments section what your views are regarding the acceptance of digital currencies by banks. Also, do mention the reasons and consequences upon which your personal opinions prevail. And if you found this video interesting, go ahead and hit the like button. And if you're new here, subscribe and click the bell icon. This way you'll be notified of all the future crypto and NFT news. We'll see you in the next one. Until then, peace.